Good morning, everyone, and thank you for joining us today for the session entitled Not-for-Profit Revenue Recognition Standards Review. This session is being hosted by Counselor Buchanan and Mitchell, and our presenters today are Molly Lambert, a principal at our firm, and Lisa Drummond, an audit manager at our firm. As a courtesy to our presenters, please mute yourselves using the small microphone image on your screen. And if you could also please keep your video off, there's a video camera button which you can also click. And when a line is through it, you'll know that your video is off. Today's session will be an hour, and it is also going to be recorded. So we'll make the recording available to you after the session as well. For those of you who submitted questions when you registered, thank you so much. Those have been submitted to the presenters ahead of time, so they'll be able to take into account your queries during the presentation and afterward as well. If you do have a question during the session, please use the chat function, and the presenters will respond to it after the presentation. They have a lot of content to cover, so they'll be focusing on the content. We will be sending the presentation slides as well as a link to the evaluation form after the session. If you wouldn't mind taking a few moments to provide feedback, we would very much appreciate it. And with that, I'm going to turn this over to Lisa and Molly, and thank you again for joining us.
Thank you, Joe. Next slide, please. Good morning, everyone. Today, we're going to be covering Accounting Standards Update ASU 2018-08 and the Accounting Standards Codification Section 606. 2018-08 is the guidance, if you could go back, please. 2018-08 is the guidance that helped to clarify what's a contribution and what's an exchange. And topic 606 is where all of the exchange accounting updates, there have been many of them, live. We are going to talk about how the two relate to each other and try and present some practical guidance as to how to approach how these affect your entity. They do probably represent some of the most significant changes in nonprofit accounting and reporting in the last several years. We're going to present the information kind of by the book, how the standards indicate, try and see if we can add some practical considerations. Before we go on, though, I want to just make sure that I stress that you have to look at the facts and circumstances of your particular entity, your specific agreements, and your environment to draw your conclusion. There's no one-size-fits-all answer to this. And really, contrary to popular belief, there is some gray areas in accounting, and I'll try and point out some of that as we go. Next slide, please. So to help make sense of how these new standards can affect your entity, we recommend that you do a little inventory of your different revenue streams, try and put them in broad categories for evaluation. For specific grant agreements, you may need to look at each grant separately, but for a lot of revenue streams, you can look at them in more broad buckets. So the first question to ask yourself is, do I even have revenue? Do I have a revenue transaction, or is this an agency transaction? To have a revenue transaction, the entity has to have control on spending. So if, for an example, an agreement says that I'm going to give you $1 million, but $200,000 of that has to be paid directly to XYZ company to do a survey. Well, that portion you really have no control over the spending. So that portion that's agency would really run through your balance sheet or your statement of financial position. Once you've decided you have a revenue transaction, now the real fun stuff starts. You have to decide if you've got a contribution, which is a non-reciprocal transaction, meaning the resource provider is giving you something for nothing equivalent back, or do you have an exchange transaction, which is reciprocal and where you're considered to have the resource provider is considered to be getting commensurate value back? I forgot to mention that if you see the word RP on my slides, it's just a shorthand for resource provider or the funder. So ask yourself, for these funds that my entity is getting, what is the resource provider getting back? If they're getting back something of commensurate value, you've got an exchange transaction. And commensurate doesn't necessarily have to mean equal, but it does mean proportional too, so in size and degree. Another big caveat is look at the substance of your agreement, not the form. And what I mean here is the word grant agreement or contract may not necessarily mean you've got a contribution and may not necessarily mean you always have exchange. In addition, things like membership dues, while they're usually exchange transactions, they're not always. Beyond the terminology and beyond the form of your agreement. What we found in practice is that many grant transactions that were previously accounted for as exchange are now being considered conditional contributions. And here I'm talking about federal awards that have qualifying expense barriers. And last, when you do this analysis to see whether you've got a contribution or exchange, it's possible you're going to end up for a class of transactions or for an agreement where you actually have a bit of both. And the by the book says that you've really got to account for them separately. Please consider materiality. Discuss with, those in charge of governance in your organization, discuss with your auditors, see if it's really a material effect. And also just know that if it's not material this year, there's a chance that it could be material in the future if your business changes at all. Next slide, please. So back to exchange to see whether you've got an exchange transaction. You're looking for basically commensurate or proportional value going back to the resource provider. Some things to keep in mind: if the resource provider actually consumes a service, it's an exchange. I mean, the easy one here is if your organization is providing management services, or if you're mowing the grass, or if you're providing temp services in exchange, the resource provider is actually consuming that. That's an easy one. Another indicator of commensurate value is if you have a grant agreement and you are participating in a survey or work product or project where the resource provider actually owns the output or the final product. That usually strengthens the argument that you've got commensurate value. It gets a little muddier if you have, open access terminology where no one really technically owns the end product. The big thing here is if the benefit is for the public good or for the nonprofit's mission, even if the resource provider gets an indirect or incidental value out of funding the agreement, that's not commensurate value. So where you're getting a grant to work on a project that's for public good or for your furthering your mission, that's generally going to be a contribution. Keep in mind that the value of what the resource provider is getting back can be evaluated at market value. It doesn't have to be just at the cost of providing it to them back. And also, I would just mention that looking at sponsorships is a bit of a gray and subjective area when you start trying to value branding and name recognition. So just keep in mind that that's again not cut and dry. For those of you who do like to read the FASB codification, the Section 958 is where all the nonprofit contribution accounting rules live. It incorporates 2018-08. Paragraphs 605, 55, 14A through 14H have some really good examples of situations, and some of them end up being exchange and some contribution. So if you have time and want to look at that. Next slide, please. Okay, so you've done this analysis, you have revenue, you have determined that you have an exchange transaction. If you have an exchange transaction or commensurate value, going back to the resource provider, you're going to apply the 606 guidance, and that's what Molly's going to cover in a couple of minutes. If, however, you decide you don't have an exchange transaction, you've got a contribution. Your next step is to decide if it's unconditional or conditional. And the reason that's important is unconditional or conditional will determine when you get to record the revenue. You know, now we have a whole nother set of terminology related to contributions. First we had restrictions, now we have conditions. And the way I think it's helpful to keep it straight is condition relates to whether you are going to get the funds or get to keep the funds, where a restriction relates to how you have to spend the funds once you have them. So in my mind, condition is first, and restriction follows once you have the funds. So to be conditional, you need two things. You need a barrier that has to be met or overcome to get or keep the funds. The getting and keeping the funds is sometimes referred to as right of return or relief of obligation to fund. The barriers kind of come in two broad groups. There's measurable performance related barriers. You have to achieve certain outputs, get a match, achieve a certain level of service, have a certain outcome. The second bucket is stipulations that limit the discretion of how the activity is conducted. And here, and they give very good specific examples, qualifying allowable expenses, cost sharing, having to keep personnel, etc. And again, these two buckets of criteria are only barriers if they're related to the purpose of the agreement and they're not administrative. We do see a lot of grant agreements where it says that the resource provider has to be satisfied with the progress of the project to fund the second year, or that financial or narrative reports have to be filed as a prerequisite to get funds. Those are really most times considered to be administrative, and they're not going to qualify as barriers. In addition, generally speaking, the requirement to adhere to a budget is not, it wouldn't qualify as a barrier. And again, I'm saying generally speaking because there are different sets of facts and circumstances. It does get a little less clear when you've got objectives and desired outcomes in the agreement, but to be a barrier, their achievement really needs to be tied to payment, specifically in the agreement. So if you could back up, please. So that does get a little bit tricky. Joe, if you could back up, please. Thank you. Okay. And just before we do move on, the second bucket of barriers that I talked about, the things that limit the discretion to conduct the activity, this is really includes qualifying expenses, allowable expenses, and this is what gets a lot of previously accounted for as exchange federal awards now accounted for as conditional contributions. And if I haven't said it enough times, judgments required. There's not always going to be a one-size-fits-all answer. And last, before we move on, in the codification, section 605, 55, 17A through F also have some good examples that help you determine if you've got an unconditional or conditional contribution. Next slide, please. So if you've got a conditional contribution, you can't record it as revenue until you've overcome that barrier. If you've got an unconditional contribution, if you've gotten the funds and it's unconditional, or the promise to receive the funds, you're going to record that revenue at that time. If you get money before you've overcome a barrier in a conditional contribution, you're going to basically park that on your balance sheet as a refundable advance until you do overcome the barrier. Once you record the revenue, you then have to look at restrictions and record as time restricted or purpose restricted. And only when you consider something an unconditional contribution do you think about including it in your donor restricted net asset schedule. And you do have some choices as to how you present amounts coming in and out of the restricted net asset schedule. There's now additional option additions and releases. Next slide, please. Okay, so we've talked about your nonprofit being the recipient of funds from a resource provider. There's part of 2018-08 that relates to the case where the nonprofit is the resource provider, i.e. you are making a grant to another entity, you're entering into an MOU, you're providing other assistance or awards. You have to do the same analysis, not to figure out when you book the revenue, but to figure out when you book the expense. So you may not necessarily in these cases always be able to record the expense on a cash basis. First question you ask is, do you, the nonprofit, and you're now the resource provider, are you receiving commensurate value? If you are, it's an exchange transaction. You record the expense when you incur it and when you get the benefit of the service. If you don't get commensurate value back, well, it's a contribution. And then you have to look at, have I made an unconditional or a conditional promise to make this payment? And here's where, if you've got conditions, make sure the conditions are actually tied to payment in the agreement. Otherwise, if upfront, you're making a promise to make a contribution, if there's no condition there, you've got to record the whole contribution as an expense upfront. And this quite possibly is going to be an interesting twist for private foundations that make a lot of grants out. Next slide, please. Okay, a couple of housekeeping items for ASU 2018-08. As I said up front, or I should have said up front, a lot of this could be review because you have already adopted most of it in 2019. If you're a fiscal year entity, you may not have, and you'll do this for fiscal 20. That's for the receiving part of it. On the making contribution part of it that we just covered, this is technically not effective until calendar year 2020. Most entities that we've dealt with have chosen to adopt both pieces of it at the same time, but that's not required. You do have some options with how you adopt 2018-08. The modified perspective or retrospective methods. Just quickly, the retrospective, you're taking it all the way back to the first day of the first period you're presenting. You'll generally have a cumulative effect adjustment on your beginning net assets. It qualifies for a change in accounting principle, which has more disclosures associated with it. And you could probably say it's a little more work to do this. Your other option, of course, is modified perspective, where you're taking it back to the first day of the year of adoption, which I'm just going to assume was 2019. You are only applying this to the portion of open contracts that you haven't recognized revenue for. Generally, you're not going to have an opening net asset adjustment. And, it's a little less work probably, but you could have two columns of information in your financial statements that are a little bit apples to oranges. And last, there are required disclosures for adopting 2018-08 and going forward. If the effect was material, it's likely that you're going to have an emphasis of matter paragraph in your opinion, just mentioning it. You're going to have a footnote that says what you adopted, when you adopted it, how you adopted it, why you adopted it, and what the effect was, or if there was no effect. And going forward, you're always going to have a conditional footnote. At the balance sheet date, you're going to disclose kind of by general type of barrier how much conditional contributions you haven't recognized in revenue yet. And when I say by barrier type, you might group them by, matches required or qualifying expenditures or certain levels of service. And last, you're probably going to see mention of adopting 2018-08 in the governance letter that your auditors send to your audit committee. Okay. So now you've decided that you don't have a contribution. So my last 5 slides don't apply to your category of transaction or to your agreement. So you've got an exchange transaction, and Molly's going to pick up from here and go through topic 606.
Okay. I'm getting some feedback, so hold on for 1 minute. Okay, maybe it's better now. Okay, why don't we go to the next slide, Joe? Okay, so 606 is finally here. I think it's, for most, I don't know about most of you, but for me, I feel like it's been a long time coming. And as you know, the original implementation date was for calendar years ending December 2019, fiscal years 2020. And then in May of this year, the FASB postponed the implementation for a year because of COVID. So now the new implementation dates are for calendar years ending December 31st, 2020 and fiscal years ending 2021. Obviously, those of you who had your audits done before the pronouncement was made have already implemented the implementation. So if you have any suggestions or tricks of the trades as we go along, please feel free to add them to the chat box. So the 5 steps, and I also want to let everyone know, I think everyone's aware that 606 applies to both nonprofit and for-profit entities. So, and I know that a lot of courses I've taken on this, there's been a lot of steps that have gone through that I said, well, why are they doing this? And I realized, oh, this is probably more prevalent for-profit, not so much for nonprofits. But as we go along, we'll use some examples and hopefully get an idea of how this relates to our area. So the 5 main steps are, the first one is to identify the contract with the customer. Second step is to identify the performance obligations in the contract. The third step is to determine the transaction price. The fourth step is to allocate the transaction price to the performance obligations. And the last step is to recognize revenue when the entity satisfies a performance obligation. Some steps may be easier for some of you than others. I think after I really did some research on this, I kind of am putting it all together. And so I just want to make sure that anyone who has not implemented 606 and feels like this is a little daunting, I think once you get into the process, you'll understand how this all works. Next slide, Joe. So I thought that as we went through the steps, and I think this was sent out to everyone earlier, we could use a little example to help us along, and I'll refer back to this slide as I do my presentation. So in this little example, Company A pays its annual membership dues to Trade Association B. The membership includes, the first one I should have just said member services, industry-wide resources, representation in front of regulators, the Hill, best practices, networking, basic overall membership services. In addition, the members allowed to attend 5 seminars. And the last one is that the member receives the monthly edition of the Trade Association's magazine. And then just a little caveat in here to go back between exchange and contribution. The dues amount paid is $5,000 and includes a $100 scholarship fund donation. So the trade association would not include the $100 scholarship in its evaluation of what makes up the exchange price. The $100 is basically a scholarship. Company A is just saying, here, I'll give you $100 for your scholarship fund, expecting nothing in return. So it's just a contribution. Next slide, Joe. So the first step is to identify the contract with the customer, and the standard describes a customer as a party that contracts in exchange for consideration with a nonprofit or a for-profit to obtain goods or services that are an output of its ordinary activity. When I was doing the research about this, they did mention ordinary activity, and they said it's not defined in the standard. So if you think that there's a contract that's out of the ordinary activity, it probably should be documented. I don't know why any nonprofit would do that, because it may come into problems with exempt status, etc. But if there's something that comes up, just document it. And then the contract is an agreement between two parties that creates enforceable rights and obligations. And there are 6 characteristics that are required to be a contract under 606. They are commercial substance, and that means that there's obviously going to be some cash flow change during the process. Approval, commitment by each party to fulfill its obligation under the contract, identifiable rights to goods or services, identifiable payment terms, and probable collectibility. So if we go back to our example of Company A and Trade Association B, I think the 6 characteristics have been met. Company A has paid $5,000 to Trade Association B. That's going to change, make a cash flow difference to Trade Association B. Both parties have obviously approved the arrangement since payment was made, and Trade Association B has approved the membership for Company A. Commitment, Trade Association B will follow its commitment to Company A and offer membership services, attendance to seminar, trade associate, and get the magazine. Company A knows what it's getting for the $5,000 it's paid. It's getting the 3 membership services, seminars, and a subscription to the magazine. Payment terms are $5,000, and obviously I'm assuming, I should have put this in the example, but it implies that the service is for a year. And probable collectibility, Company A paid, so the contract is definitely enforced. And then on the right-hand side, in addition to membership dues, yes, I will have a question on certification fees, and let me talk about that for a minute right now. I think we have time. Membership dues, certification fees, and what I'm talking about with certification fees, I think some nonprofits have programs offered to their memberships that get them certified or somehow get a special certification within the industry. So in that case, a nonprofit may have to perform training, allowing to let the person get trained, and then to be certified, the participant or the customer would have to take an exam. So let's say, so there are 2, we'll get to the next slide, we're getting ahead of ourselves. Actually, there's 2 performance obligations that have to be met for the revenue and the contract to be fulfilled. So that's what I'm saying about certification fees. If somebody wanted to think of something else, I was just thinking, I know some nonprofits have this specialty. So that's what we were talking about there. Next slide. Okay, so now we're talking about identify performance obligations in the contract and distinct services. When I was doing this, putting this presentation together, I was thinking of performance obligation is what are the responsibilities of the provider, or in our instance, Trade Association B. They are obligated to provide to the customer distinct services. So the distinct services are what are the benefits given to the customer. And, you know, pretty self-evident. I think don't want to sound like a broken record, but in our case, membership services, seminars, and a subscription to the journal. And in a contract, the services need to be distinct and identifiable, and they need to be separately identifiable. I one time had a client who was working with a vendor, an IT vendor, to create an app for its members. And as part of the agreement, there were really two steps. The IT provider, or the vendor, had to first upgrade the customer's website or database. What I'm not really a software guru, but upgrade the software before they could create the app. So in that case, there were two steps that needed to be done. It would only become one distinct service when they were both done. There would be no need to upgrade the database or the software unless the app was developed. So that's why the services are identifiable and separately. Next slide. Okay, so here is determining the transaction price. And this is probably one of the biggest changes in the 606. I'm thinking that most people will recognize revenue when the transaction is done. In other words, okay, when you've paid your dues, I'm going to record got the cash, going to record the revenue. Now what they're saying under 606 is that what is the price at the expected amount? And it may require estimates. In some cases, it may just be very cut and dry. I'm going to pay $100 to go to this seminar, done. But let's say there's variables, there's discounts involved, there's a scholarship award involved, or let's say that there's a refundable part that may need to be paid back to the customer. All of those all of those adjustments need to be considered when the transaction price up front, when the contract is being originally recorded. In some of cases I think with the nonprofit industry, it could be pretty self-evident. If if a member is paying a discount for their dues, obviously, I think that payment would be made up front. It could be easily recognized when the payment is made. I think when it gets a little more difficult, and if we go back to our example, which I have here somewhere, is if there is a right of return, if the customer has a right to a refund. So if we go back to my example, and I didn't put it down here, but let's say company A has up to 3 months to withdraw its membership. So, and let's say that Trade Association B says, based on our historical history of data, we feel like 2% of our memberships will withdraw and ask for a refund within 3 months. I hope that's not practical, but let's just say for argument's sake, for this example, it is. So in that case, Trade Association B has to record a liability and reduce the transaction price for the possible refund that may occur. So, and I'm doing the math in my head, but let's say the transaction price is actually, the company paid $4,900. So instead of recording the $4,900 of revenue, 2% of it, I guess, or 980, I think that's my math, would have to be recorded as a potential liability. It doesn't mean that it won't ultimately be recognized as revenue, but when given the transaction price at the beginning, when Trade Association B is entering into the transactions at the beginning of the year, the liability has to be recorded. The idea is that it's based on estimates and not going back and forth. But like we said, down the road, if it was a great year and no one withdrew their membership, then ultimately the revenue could be recorded. Some other kinds of variables, I think the one I want to talk a little bit about in addition to the possible refund is financing provisions, and that could happen if there are lifetime memberships. I had one client who did provide lifetime memberships, and so that every year the revenue would have to be discounted based on time value of money. Next slide. Okay, so once we've figured the transaction price to each contract, we need, if there is more than one obligation in the contract, the transaction price needs to be allocated proratably based on the standalone price we think each benefit or each service in that contract is worth. So in our case, we have 3 distinct services in one contract. We have the member services, possible attendance to seminars, and the newsletter subscription. So now the nonprofit has to go back and go, what is the value of each of those separately? Some are easy to do, some are more difficult to do. And it's basically saying, what is the standalone price? That's the wording that they're using. So what's the standalone price for membership? What's the standalone price for a seminar? What's the standalone price for a newsletter subscription or a magazine subscription? And there are 3 approaches that 606 spells out. The first one is the adjusted market assessment approach. And that's basically going out to the market and saying, what's a customer willing to pay? It could be, and it basically, look at competitors, look at the industry, look at the geographic region, saying this is what we think it will be willing to pay. The next one is expected cost plus margin approach, and that is basically taking all the costs, the internal costs that are needed to provide the benefit, adding up all the costs, and then adding up an appropriate margin to the good or service. And basically, again, it's going to be using judgment and understanding what you think you can get, what you think it's worth on the top of doing the work. What's the markup? That's the second one. The third one is a residual approach, and that's probably the last one to use. And basically what that is that there's a lot of transactions in the contract. We can identify maybe 3 out of 4 of selling prices. So you take the difference, and that would be the residual. That would be what's left to value that transaction at. I think I did write down something. Hold on for 1 second, because I said, I guess I was, wait a minute, let me see if it's just really what's left after determining all the service prices. And a lot of times that would be used if there's a new product, don't know what it's worth or anything. So that's what it is. And it's just, there are criteria. One is that you cannot identify a standalone price, and there's really nothing in the market else to go for it. So again, we have to use judgment on that. So next slide. Okay, so once the once we determine our transaction price, we're going to allocate it. Once we determine our standalone selling prices, we allocate it to the overall transaction price. So in our example, total membership services was $4,900. But we think in standalone selling prices, the value for each one separately totals $6,000. And so then an allocation is made pro-ratably between what the standalone selling prices would be to our transaction price. So in our case, member services, we think is 50% of their 3%, $3,000, which equals 50% of our total price. So we take 50% of our total transaction price. So it's just kind of following a mathematical, it's just an allocation exercise and how we're allocating the transaction price. Next slide. Okay, so now we come to recognizing revenue. And I think this is when revenue is basically when the customer has control of the asset or of the service. The provider no longer needs to do anything. It's not worth anything to them. It's just basically the contract is complete. The arrangements between the two are done. There's just no need for the nonprofit to work anymore to provide any more services to customer A in our point. So revenue is recognized over time, and as we said, or at a point of time, and obviously I said when revenue is recognized. So if we go back to our example, which we all have, member services would be recognized over time. In other words, the member service provisions for providing best practices, representation, networking is really over the life of the membership, which would be a year. So that would probably be recognized over a 12-month period. attendance to the 5 seminars, that revenue would be recognized when customer A attends a seminar. Then we can take that would be done. It's a point in time. The obligation was done. We don't have to worry about anything else. And it's the same with the trade association magazine. Once the magazine has been given to customer A, the revenue has been recognized. And then, so that's basically the 5 steps. And I think it can get a little daunting on how we recognize revenue and what we do. So why don't we go to the next slide, because there's some things I want to talk about. Well, how will this impact your organization? And I think that the way it's presented, it could get pretty detailed, and we want to make it as simple as possible, because obviously we want to keep the revenue and get it right, but everyone else has other work to do as well. So I think the first one is that use of more estimates and use of more judgment under current guidance. In other words, as I said, the transaction price is based on expectations. So someone's going to have to judge, well, like we just said, we think there's a 2% chance that people will have a refund of money. That's an estimate, a judgment that needs to be documented. How do we come up with the transaction prices for each of the services within the contract? How is that obligated? How do we get those standalone prices? So that's something that's going to have to be done. And then the second one, I think, is better documented processes and internal controls. And I think this is going to be really, really important. Like I said, this could create a lot of havoc, which may not be needed. I think under the standard, even though there are different obligations in a membership dues, it doesn't mean that each aspect of each service, i.e. subscription, membership dues, and seminars, needs to be recorded separately. It could be bundled all together if that makes it easier for your accounting records. However, there may be a need to expand your chart of accounts to include liabilities that relate to the revenue recognition. In other words, do you really want to say, okay, based on our standard here, we have a liability for 5 seminars. We have a liability for seminars. We want to show that differently than the member services obligation. It can all go into membership revenue, but it may just be better to record it that way. And I think the most important thing in internal controls is documenting the procedures for how you and your organization are going to implement 606. What are the processes? Who is going to determine the performance obligations in the contract? How are exchange transactions? And Lisa referred back to this as well. What is the process for recognizing revenue streams between contributions and exchange transactions? And once the exchange transactions have been identified, what's the process? Does it start with the membership program department? How does accounting get involved? Who does the overall approval? And then how is it going to be recorded in the general ledger? Who reviews those transactions, reconciles it back to membership records? So there probably will be a little more updates to the policies that are going into effect with 606. Then the next one is meeting with lenders, since the new accounting guidance could increase liabilities and impact debt covenants. I think this one is probably going to have a bigger impact on for-profit entities than nonprofit, but it could have an impact on nonprofits. Obviously, with both of these recognitions, what Lisa talked about with refundable advances, and now what we're talking about with 606, there may be significant liabilities showing on the balance sheet. That may change the ratios for the debt covenant. So if that does come into play, go talk to your lenders and just see how that can work out. Next slide. Okay, and then the next one is updated technology to ensure contract performances are tracked to accurately record liabilities and earn revenue. It's really figuring out if there can be an integration between databases, program databases, membership databases, and the accounting records. If not, does all this have to be kept separately on a spreadsheet and then entered it in? So it's hopefully technology can be used so that the tracking of services provided under 606 in exchange transactions that have multiple services can kind of just flow right into the accounting transactions. So that may be a good, that will probably take some time to work on once the procedures have been established about, okay, how do we want to identify our exchange transactions? How do we really want to record them so that we get realistic information, but we're also being efficient at the same time. And then the last one is a change to standard contract terms, including payment arrangements and performance obligations, just to be sure that the treatment is in line with what the board and management's expectations. So I was thinking about this today, and in our example, we have memberships. Memberships could be offered annually during at the same time as the nonprofit's fiscal year, or it could be offered monthly. If it's offered monthly, I could see how this could really become a headache. So in this case, maybe in implementing 606, if this is the case, the organization may want to consider redoing its membership structure and saying, okay, we're going to have everyone pay on the same fiscal year as ours so that we can accurately, we can more efficiently implement 606 in our accounting information. And so that's it. I'm going to turn it back to Lisa, who's going to talk a lot about disclosures and stuff. And I just want to end by saying that I think the first year of implementation will probably be maybe a bit overwhelming or daunting, but once the procedures are in place, spreadsheets, documentation, software, and how it's all going to work, it may be easier than we think. Okay, Lisa.
Thank you, Molly. Joe, if you can progress the slide. Okay. Some housekeeping items for 606 to make sure you're adopting the 2014-09 and all the related ASUs related to that. Molly mentioned that this was originally effective for calendar 2019, but in the middle of busy season in May, there was a 1-year deferral allowed. So again, some of you have adopted, some of you have not adopted. Adoption options, you do have 2 options. They're both retrospective. One is a full retrospective that basically recasts the comparative year that you've already presented. You'll have a cumulative effect adjustment. It is an accounting change that brings along with it additional disclosure. Arguably, full retrospective is a little bit more work. Modified retrospective, you're adopting it on day 1 of the year of adoption. So if you adopt it in 2020, you're adopting it effective January 1st, 2020. You're going to have a cumulative effect adjustment. You do again run the risk of having one column accounted for one way and one column accounted for another way, and that's really only matters if adoption has a significant effect. Last bullet here, there are many disclosures, and Joe, if you want to progress the slides, we'll get into those. Before I start about the disclosures, some disclosures are optional and some disclosures are required. I'm really only going to touch on the required disclosures here. Again, like the other ASU, if the adoption of 606 resulted in a material impact to your statements, it's probably going to be a emphasis of matter paragraph in your opinion. You probably, either way, you're going to see it mentioned in your governance letter that your auditors issue. You will have an adoption footnote. Again, you have to say when you adopted, how you adopted, why you adopted, the effect of adoption, or say there was no effect other than additional disclosure. You also have to say if you applied it to open contracts or all contracts at the adoption date. And if you used one of the allowed expediencies, practical expediencies in the update that they allowed, you have to mention that too. So you've got your adoption footnote. In your accounting policy notes, you want to make sure that your disclosures are consistent and kind of acceptable within the 606 framework. So anytime you're talking about an exchange accounting area, you probably want to make sure that the reader can understand from what you've written whether you're recognizing it over time and what that period of time is, or at a point in time, and what the trigger point is for recognizing. The 606 requires certain statement of financial position information. If you can't glean that from the statements, you may have to put in a table, particularly in the year of adoption. And on an ongoing basis, you do need to disaggregate your exchange revenues to show how much was recognized at a point in time or over time. We've seen little tables in the footnotes that basically take the line items that have been accounted for as exchange and will separate those out as necessary in a column for overtime or at a point in time. And basically what they're looking for is they want to make sure that the reader of the financial statements can tell from your statements in your footnotes how you accounted for things, whether you accounted for them as contributions or exchange, because the accounting is frankly different. Next slide, please. In addition to the number of footnotes, there are some required qualitative discussions that they'd like to see. They want to know what judgments you used in applying the new guidance, if there's any pertinent qualitative information about the performance obligations, and how economic factors might affect the cash flow and revenue that you're recording. Next, please. A couple of considerations with respect to 606 and 2018-08. Be careful with terminology. Things accounted for under exchange rules. You're going to see words like deferred revenue, accounts receivable, unbilled contract receivables, performance obligations, etc. When you get to the contribution accounting, this is where you've got to consider, things like conditions, restrictions or not. Money received in advance of recording as revenue is going to be called a refundable advance. Your receivables are going to be labeled consistently, and this is also, where you're seeing your net assets with donor restrictions. Be careful if you use the words grants receivable and grants revenue. Somehow your financial statements really need to specify how you've accounted for those, whether it's contributions or exchange. Having the disaggregation of revenue table can be helpful, or doing some additional labeling on the face of your financials could be helpful too. Next slide. Okay, so we're almost in closing here. From a high level, you've had some choices about these two standards. Some of this was clearly review for folks who had adopted 2018-08 already, although some of the parts of 2018-08 you've got to do every year, when it has to do with, conditional or not conditional. But clearly you have some choices. You could have adopted 606 early or next year, and you have adoption options. So just know you do have options. Second, it really starts with thinking about what you have. Do you have revenue? And then from there, do you have a contribution? You follow one set of rules. Do you have an exchange? You follow another set of rules. And honestly, I'm sure this is obvious as we were going through here. There's going to be a lot of additional disclosures. Okay. We've got about 5 minutes left, and Joe, if you'll progress the slide quickly. I did want to mention that if you look on our website, you can see a lot of different virtual webinars that we're putting on. The next 4 are listed here. You can click on the link. We've got a variety of topics. We want to thank you for attending today's seminar, of course. Joe, next slide, please. And also wanted to mention that on our website, there is a separate section where we've put together resources and information that we have on things that will help you with the financial impacts of COVID-19. So that's available on our website as well. We have 5 minutes left. If you'd like to stay on, and we can very quickly, I can run through some of the questions we received in advance. I do believe that we tried very hard to address, make sure that we addressed the majority of these. There was a question related to the PPP and a question related to lobbying, both really kind of not within the scope of this presentation, but please feel free to reach out to your CBM contact or to one of us. A question about who writes footnotes in an audit. Unfortunately, I'm going to say that it depends. Some clients do update at least the number portion. It does get into, who's actually doing the processing and the production and what's most efficient. But in a best practice world, clients would prepare and update the footnotes and the auditors would review them. Comments about, audits being expensive and do we need those every year? Is there a standard or requirement? Alternatives? That's really a decision for the board, for management, for, you've got to consider stakeholders' needs, public perception. If you've got, loans that have covenants that require audits, if some of your donors require audits. So I hate to give you a wishy-washy answer, but we're back to the gray areas. And a question about the best way to track conditional contributions. We've really seen entities tracking what they've got outstanding using spreadsheets. I don't know if it's possible to incorporate a report into a CRM system or something like that. Okay, I believe we have 3 minutes left. If there aren't any further questions, we want to thank you again for participating. I hope you have a good day, and please contact us if we can be of any assistance for you.